Alright, let's talk about how I know what stock to buy and how I got to the feeling where it's just numbers on the screen, and hopefully that can be some inspiration for you to get to that very point. I was inspired by the comment section on this one, and I had a lot of thinking regarding how to structure this video, but I found an excellent way, in my opinion, to really dig into the meat of this question. It will be quite a different video compared to other videos on this topic. I will try to get more on the structure of thinking, the high level overview, rather than going into details with the discounted cash flow analysis. I would rather hope that after watching this video you will understand why we do the discounted cash analysis and why people do the calculations that they do, because for a lot of beginners, this might not be clear, but with the basic frameworks that you get from business school and from work experience in banking, then it will be much clearer. So let's start in that end. Let's start with the basic calculations that you're doing when you're starting to learn finance and you're starting to build a framework of theory and thinking for yourself. This framework will be flawed, but then it will evolve with the experience that you have from business. So to start off, a lot of people that go into the banking sector, they will learn formulas. And the problem here, as George Soros talked about in his book about the theory of reflexivity, is that when everybody's thinking with a certain framework, then that framework tends to come true. It's a self-fulfilling prophecy. It's a theory of reflexivity. Very interesting thought of mine there. Alright, so what do the young bankers learn? Well, in the finance courses, they will learn about the certain asset classes, of course, and then they will run calculations on a successful and a not successful scenario and what the return on the assets will be, and they will try to mix a certain portfolio. So imagine we have asset A, let's say it's a stock. In a successful scenario, we get a probability, a chance for this, let's say it's 70%. The stock will increase by 25%, and then we have a not successful scenario, you will lose 20%. Should you make this investment? Well, on a balance of probability, it's quite clear that it will be a positive investment in the long run. You have 25% return with 70% certainty, and then 20% loss with 30% certainty. So if you flip that coin over and over again in a repeat game, you will make a ton of money. And then we learn with these volatile asset classes, we have this higher chance of good returns and this high chance to get, a very bad return as well in some cases. But this is the basic framework. This is how an asset class is looked at when you're doing the complete beginning guide. And then of course an asset like bond, you will have a 95% chance to get 5%, and then maybe a 5% chance to lose 2% or something like this. So we see volatility, we see different risks, and that's entering the frame of mind early on. But of course, in the real world, we're not getting these probabilities, and how do you know how certain it is for a stock or a bond to increase by a certain percentage? Well, in this case, we look at top line growth, so the growth of revenue. You see me talking about that on the channel all the time. How much are they likely to increase revenue? We saw Palantir take a massive leap recently when they have that 70% year-on-year growth on commercial revenue for the US. And we're seeing other companies making massive leaps when this top line increases as well. So that's an important part of calculating what an asset, potentially how it could perform. So let's say a company increases revenue massively. Well, then that's a positive scenario that will be attributed. If this action happens, well, then the asset will increase in value by a lot. And then likewise, you're missing expectations, you're having bad top line revenue growth. Well, in that case, the stock is going to have a bad outcome. And you're going to calculate these scenarios, you're going to calculate the bottom line as well. and then we're going to discount that cash flow because, you know, alternative cost, inflation, etc. And we're going to get different scenarios, and all the different analysts from all the different finance houses are going to put different numbers on what they believe revenue will be, what they believe profitability will be, and in the models they will get different outcomes, and they will use this to set target prices and try to evaluate a certain stock. All this is quite complex, but just understand that there's a certain probability of a positive outcome and a certain probability of a negative outcome. And Wall Street will try to predict this with calculations. That's not how I do it with stocks. I think that it's too theoretical, and I think that there's a better way, but it's still super important to understand this framework because it dictates potential returns. What I do is that I gathered a ton of inspiration from the book that Peter Lynch wrote, One Up on Wall Street. I've seen the theory being used in practice a lot of times, very successfully, even from a young age. I remember the neighbor from across the street was a writer for a finance newspaper. He talked to me about a stock called CTT Systems, where he understood the business well, he understood the order taking of the airplane industry, how it works, and that when they get big orders, they make large returns, and told me to put my money into that stock. And indeed I did for a few months, but I didn't have the patience. I sold, and literally the next day they got a big order and stock went through the roof. But I wasn't mature enough at that point. But this understanding of business, because top line revenue, what is it in reality? It's customers, whether it's us consumers or another business, if it's a B2B business, enjoying a product, enjoying it so much that they keep purchasing it and keep purchasing more of it. And one example from One Up on Wall Street is the La Quinca or something like that, hostel that Peter Lynch himself went out to try, and he enjoyed the service a lot. And by extrapolating this into business terms and calculations, such a good service, a good price point, good locations, everything, well, a lot of customers are going to choose this, and this will result in revenue growth. So just understanding this. And Lululemon is another example. If you had a sister or a mother that all of a sudden start buying this new brand and all the women love it all of a sudden, and it's gaining a ton of popularity, you could have discovered this before Wall Street's calculations pushed stock price higher for Lululemon. You could have been there before and understood. And this is the business knowledge where it comes in. And what I do is I use this YouTube channel a lot. I read on the comments. I see a ton of suggestions on different stocks, and I do analyses. And in some cases, I find companies that I understand, that I like. And then when I look at the valuation in the final step to see, is this a reasonable price in my opinion? And if I like that too, then I buy. It's a tedious process. It takes a lot of time. And in many cases, I get a suggestion in the comment section and I look at the stock, it's fairly valued, but I don't really understand the business. I don't understand where top line is going to come from. I don't understand how operational efficiency will increase the profit margins. And in that case, I just don't buy. Another thing regarding picking stocks is that you have to be prepared to be wrong, because you will be wrong in some cases. Just look at Oscar Properties for me. In that case, I took a big risk. There was potential for a huge reward, and there was potential for a lot of downside as well. But the good part with this is that you can be wrong on a few stocks, and if you're really, really right on one, like Porch Group, and you're very right on another one, like Palantir or StoneCo in this case, well, then that's going to drive portfolio performance up into the stratosphere. It's really going to push the value up there, and it just feels ridiculous at this point. Looking at the portfolio yesterday, I did a quick login, and I see like the portfolio that I show here on YouTube from time to time, going up with 5%, and it's more than 100,000 Swedish, so like 10,000 something dollars in a single day. And it's just ridiculous, like the feeling making that money that kind of quick on a good day in the stock markets. It's quite a surreal feeling, but I've gotten there through being very careful in selecting stocks and not taking a bet where I felt that this risk of a negative scenario was much larger than that of the positive scenario, and I spread my risk by picking more stocks. I've done several bets, and if you're up there in 7 or 8 different bets where you spread it evenly, well, then you've diversified away systemic risk. And if you take on more shares than that, you put more companies into the portfolio, well, then you might as well just buy an index fund and stick to that, because you're going to be so diversified that if you make a big home run, then it doesn't really matter for your total net worth. It's going to carry the portfolio a bit, sure, but it's not really going to matter. It's not going to be those kind of life-changing numbers where it just feels ridiculous. So let's summarize. We have the framework, positive, negative outcome. We attribute certain chance, certain probability to the different outcomes. We try to understand these scenarios not in terms of theory, but in terms of real life experience and business knowledge, because this way we can more accurately predict this. It's all about being slightly more accurate. If you just have a few percentage points more towards a good outcome because of your business knowledge, in the long run you're gonna outperform and you're gonna make a ton of money and beat Wall Street, one up on Wall Street. And point number 3, go and read Peter Lynch's book, One Up on Wall Street. And then also a quick shout out to the stock screeners. If you're in there and you have learned some valuation skills, you're looking at price to earnings, for example, you're looking at dividend yield or some other metrics, well, just use, for example, the stock screener on Macrotrend, and you can filter in the stocks and you can see if you find a company in a vertical you understand with a valuation metrics that you like, and then you can comment that stock below in the comment section on one of my videos. I read all the comments and I can also take a look at it, and hopefully there's potential there to make a ton of money. So I can't stress that enough. I source a ton of my research from this channel. It's been truly a blessing. I'm very grateful, guys. For example, Hueng LNG came from a comment here on the channel. We made a ton of money. And Porch Group also came from a comment here on this channel, and I'm very, very, very grateful for that, because it's made me so much money. It's just ridiculous at this point. So once again, thank you, guys. It's just booked a trip to Brazil here for 3 weeks, and it would not be possible without having this huge cushion built up from being invested in the stock market. And it just feels so comfortable to be able to do what I want and have that type of freedom. So once again, thank you. And if you watched all the way to the end, hopefully you found a ton of value in this video, and if you did, press the like button and let me know. It motivates me to make more videos on general finance topics and not just doing stock analyses. It can be really easy to just go into that full money making mode and trying to find new opportunities, but it's just as important to continue to educate, have a communication, and keep asking for comments with stock recommendations, because I truly love those, and those have truly been a blessing over the years. Alright, that's been it for this video, and as always, hope you guys make a ton of money, whatever investments you decide to make. Take care now, bye bye.